Starting a business can be an exciting adventure. The thrill of creating something from scratch, the freedom to make your own decisions, and the potential for financial success are all incredibly motivating factors. You get to be your own boss and pursue your passions. Whether it's turning a hobby into a career or solving a problem you care deeply about, the possibilities are endless. But sometimes, going it alone can be daunting. The weight of responsibilities, the endless tasks, and the isolation can make the journey overwhelming. That's where partnerships come in. They offer a way to share the load, bring in diverse perspectives, and enhance creativity. Imagine teaming up with a friend who shares your vision and drive. Together you can brainstorm ideas, solve problems, and support each other through the ups and downs. You combine your skills, resources, and ideas to build something amazing together. Each partner brings unique strengths to the table, making the whole greater than the sum of its parts. That's the essence of a partnership. It's about collaboration, mutual support, and shared success. In simple terms, a partnership is a business structure where two or more individuals come together to run a business. They pool their resources, share responsibilities, and work towards common goals. They share the profits, losses, and responsibilities that come with it. This shared approach can make the business more resilient and adaptable. It's like a joint venture where everyone contributes and benefits from the collective effort. The synergy created can lead to greater innovation and success. Think of it like baking a cake. Each ingredient plays a crucial role in the final product. One person might be great at baking, understanding the science behind the perfect cake batter, while the other is a whiz at decorating, turning a simple cake into a work of art with their creative flair. By working together, they create a delicious masterpiece that's more impressive than anything they could have achieved alone. This is the power of partnership, combining talents to achieve extraordinary results. Imagine you and your friend decide to open a restaurant together. It's an exciting venture filled with dreams and aspirations. You're both passionate about food and eager to build a successful business. The initial enthusiasm is high and you both bring unique skills to the table. But what happens if one of you starts slacking off? The workload becomes uneven and resentment starts to build. Or if disagreements arise about how to run things, conflicts can escalate, leading to heated arguments and a breakdown in communication. That's where trust and cooperation become paramount. They are the glue that holds the partnership together, especially during tough times. Trust is the bedrock of any successful partnership. It means having confidence in each other's abilities and intentions. It means believing in each other's abilities, honesty, and commitment to the shared goals. Trust fosters a positive environment where everyone feels valued. When partners trust each other, they can communicate openly, resolve conflicts constructively, and make decisions that benefit the partnership as a whole. Cooperation is equally important. It ensures that tasks are shared fairly and that everyone's strengths are utilized. It's about working together harmoniously, sharing responsibilities fairly, and valuing each other's contributions. Cooperation leads to a more efficient and enjoyable working environment. Just like a football team needs all its players to work together to win a game, a partnership thrives when everyone pulls their weight and supports each other. When trust and cooperation are present, the partnership can overcome any challenge and achieve great success. Now that we understand the importance of trust and cooperation, let's delve into some key features that define partnerships. Mutual agency. This means each partner has the authority to act on behalf of the partnership. For example, if one partner signs a contract, it binds all the partners. Profit and loss. Sharing. Partners share the profits and losses of the business according to a pre-agreed ratio. This ratio is usually outlined in the partnership agreement. Joint liability. Each partner is personally liable for the debts and obligations of the partnership. This means creditors can go after the personal assets of the partners if the business can't meet its financial obligations. Partnerships come in different flavors to suit different business needs. Let's explore a few common types. General partnership. In this type, all partners have unlimited liability. They are actively involved in the day-to-day operations and management of the business. Limited partnership. This type involves both general and limited partners. General partners have unlimited liability and manage the business, while limited partners have limited liability and are typically passive investors. Limited liability partnership, LLP. This hybrid structure offers limited liability to all partners, protecting their personal assets from business debts and lawsuits. Section 5. Setting up a partnership. Forming a partnership is, well, relatively straightforward. It starts with a partnership agreement, a legal document that outlines the rights and responsibilities of each partner. Think of it as the partnership's rule book. It covers aspects like name of the partnership. Choosing a catchy and memorable name is essential. Contributions of each partner. This includes money, assets, skills, or even their reputation. Profit and loss. Sharing ratio. How will the profits and losses be divided among the partners? Responsibilities and duties. Who's responsible for what? Decision-making process. How will decisions be made? Withdrawal or death of a partner. What happens if a partner leaves or passes away? Section 6. Capital contributions. The foundation of a partnership. Capital contributions are the resources that partners contribute to the partnership to get it up and running. These contributions can be in the form of cash, which is the most common form of contribution and represents the money partners invest in the business. Partners can also contribute tangible assets like equipment, vehicles, or property to the partnership. Sometimes a partner's skills and knowledge can be as valuable as cash or assets. Maintaining proper records of capital contributions is crucial. Each partner's contribution is recorded in their individual capital account, which reflects their equity or ownership in the partnership. Section 7. Adjustments and settlements, keeping things fair. Over time, adjustments might be needed to ensure fairness among partners. These adjustments could be due to unequal contributions. If partners contribute different amounts of capital or time, adjustments might be made to reflect these differences. Changes in profit and loss sharing ratio might also necessitate adjustments if the partners decide to revise the original agreement. When a new partner joins or an existing partner leaves, adjustments are necessary to reflect the changes in the partnership's capital structure. Settlements occur when the partnership is dissolved, either by mutual agreement or due to unforeseen circumstances. During settlement, assets are liquidated, debts are paid off, and the remaining funds are distributed among the partners according to their capital account balances. Section 8. Partnership accounting, keeping track of the money. Partnership accounting is crucial for tracking the financial performance of the business and ensuring transparency among partners. It involves recording transactions. Every financial transaction, such as sales, purchases, expenses, and investments, is recorded in the partnership's books of accounts. Separate capital accounts are maintained for each partner to track their contributions, withdrawals, and share of profits or losses. Periodic financial statements, such as the income statement, balance sheet, and statement of cash flows, are prepared to assess the partnership's financial health. Section 9. Profit and loss. Sharing. Reaping the rewards and sharing the burden. One of the most important aspects of partnership accounting is determining how profits and losses are shared among the partners. This process is crucial because it ensures that each partner is fairly compensated for their investment and efforts. It also helps in maintaining transparency and trust within the partnership. This is typically outlined in the partnership agreement and can be based on an agreed-upon ratio. The partnership agreement serves as a foundational document that clearly specifies the terms and conditions under which the partnership operates, including the profit and loss sharing mechanism. Partners can agree to share profits and losses in a fixed ratio, such as 50-50 or 60-40. This fixed ratio is often determined after careful consideration of each partner's contributions, both in terms of capital and effort. Profits and losses can also be shared based on the proportion of capital each partner has contributed to the business. This method ensures that partners who have invested more capital receive a proportionately higher share of the profits, reflecting their greater financial risk. If partners contribute different levels of service or expertise, the profit and loss sharing ratio can reflect their contributions. For instance, a partner who brings in specialized skills or industry knowledge might receive a larger share of the profits compared to a partner who contributes less in terms of expertise. For example, let's say a partnership earns a profit of 1 lakh rupees. This profit needs to be distributed according to the agreed-upon ratio, ensuring that each partner receives their fair share. If the profit-sharing ratio is 60-40, one partner would receive 60,000 rupees and the other partner would receive 40,000 rupees. This clear division helps in avoiding any potential disputes and ensures smooth financial operations within the partnership. Understanding partnership accounting is essential for any aspiring entrepreneur considering this business structure. It not only helps in managing finances effectively, but also in making informed decisions that can drive the business towards success. By grasping the fundamental concepts of capital accounts, profit and loss sharing and financial reporting, you'll be well equipped to navigate the world of partnerships and build a successful business with your partners. This knowledge will empower you to create a robust and transparent financial framework, fostering a collaborative and prosperous business environment.